You think the industry that you're in is going to see a major shift because of AI?
AI is what is essentially about replacing to some extent and human task. The computing power which is required to build algorithms which can substitute the more complex activities of the human brain is much lesser compared to the computing power which is required to be built in for it to replace more menial tasks which are done by humans, such as movement of your hands or perception and so on. But more simpler activities which are more touch and feel, which are more about perception, which are more about psychology. And we didn't talk about that, but psychology plays a most important role in my view as far as investing is concerned. Your behavior, we talk about FOMO, we talk about missing out on ideas, we talk about greed. All these are emotions, and the level of markets being influenced by emotions on a day-to-day basis is far, far higher than just stock picking alone and getting the next best idea and ensuring that your corporate numbers flow through and your quarterly results come in. I think that is not as much important as getting your mental mechanism right.
Welcome to Get Real About Wealth, a new podcast brought to you by IndusInd Bank. I'm your host, Sonia Shenoy, and today I'm excited to welcome Taher Badshah, the President and Chief Investment Officer of Invesco Mutual Fund, to our podcast. With nearly 30 years of experience, Taher is known for navigating market volatility and making contrarian bets that focus on long-term growth. His expertise lies in identifying opportunities in mid-cap and industrial sectors and crafting strategies that stay resilient through changing market cycles. So let's dive straight in. Taher, I think out of the 30 years of experience that you have, I have known you for about 16, 17 years now,
Sure.
and it's been great to know you and great to have you here on the show today.
Thank you very much, Sonia. Happy to be here.
This show, Get Real About Wealth, is more a talk on your personal journey, right? Because I do know that you started off with an electronics background and then you got into this fascinating world of mutual funds. So take us through your journey so far and how it's been for you.
Yeah, so you're right. Actually, I started off as an engineer and I worked as an engineer as well for a couple of years. But times were different at that point in time. I'm talking 1990s, early 90s, and not really much was happening in India. In fact, we'd almost gone through a financial crisis and we pledged our gold and stuff like that, as we would recall. And therefore, to that extent, opportunities were relatively few and far between, particularly as far as the engineering field was concerned at that point in time. The technology and IT services sector started taking off probably a few years later. So it was a difficult period in general, and but as an engineer, I always was a little, inquisitive. We had those tendencies to actually be probing about things, and I was looking for activity which was probably a little more broad-based, which would not necessarily confine me to something very straightforward as such. And I got on to doing my MBA, after a couple of years of work experience. And that was a model actually which was being followed by most of us. Engineer stroke MBA was actually the way to go. And I said I will try and figure out what to do in life once I am in. So luckily I managed to be in, and then at SP Jain, which was not very recognized at that point in time as an institute, but we had a very different learning format, and that was very exciting. And it was during that period of time that I discovered that I have a inkling for financial services. Obviously, I was also looking for a way which was the fastest way up the ladder, because it was very humble beginnings at that point in time. So, and therefore it just dawned upon me that maybe capital markets and particularly equity investing is something which caught my attention. Simply because I thought I could bring some of my skill sets as an engineer and that, probing attitude to bear. And I think that's how it started off. And by the time I was done with my MBA, I was pretty clear that the only thing that I wanted to do was equity research. So
you were clear then on that
equity research was the way to go. I literally had a cold call interview type thing, and I walked in with my profile to one of the houses. At that point in time, it was Inquire. It was an arm of Motilal Oswal, by the way. It was known as Inquire, short form for Indian Equity Research.
Oh, nice.
Okay, it was an acronym for Indian Equity Research. So I walked in one fine day with my CV in my hand and looking for a job, so to speak. And I had the good fortune to meet Mr. Ramdev Agarwal at that point in time, and I had a couple of hours of conversation with him, and most of the questions that he asked me I didn't have answers to. All are centered around equity and investing, but I was a complete newbie, so I didn't really have any answers.
Is there any piece of advice that stands out for you from any of your mentors?
I think a lot. I think the way they've kind of, just looking at their own evolution and the way they have conducted themselves in their lives. All have started off at very interesting stages of their own careers, and at times when India was not doing well, but the kind of conviction that they've always had in the strength of the Indian economy, or for example, or for that matter, the strength in the Indian equities market, for that matter. I think that conviction was something which rubbed off on me a lot. I mean, it internalized my thinking, and like I said, I in any case was quite clear in my head, reasonably clear in my head, that this is the way to go, and it just got so well reinforced by the conviction that these people brought to the table. And I think just work ethics at the end of the day. I mean, I see both of them even today, after I having been with them, having seen them for 30 years, still being as committed, as energetic, and as enthusiastic about the opportunity in front of us as a country and as a nation. So that is something which I've always taken. There have been several things along the way, and in a regular working relationship, we obviously learn a lot of things.
Of course.
But these obviously are things which stood out for me.
But has your investment style changed over the years? I'm asking because, now a growth investing, of course, has been
Always there.
Yeah, I mean, it's held on for a longish period of time. But now in today's day and age where, a lot of even non-profitable companies, loss-making companies are doing really well in the market. There are new age tech companies that are picking up. There are waves where, defense, PSUs doing well. So a lot of people feel FOMO about missing out on the rally. How do you deal with all of that?
So it's interesting that you asked this, and especially for, in running a value strategy, these are things which it's like, you are on a diet and you are actually seeing a lot of food in front of you, and you know that there's such a lot of variety, but you can't have it. So it's that is what value strategy is all about, because you have to pick your opportunities as they come along the way. And India typically has been a growth-oriented market, right? It's never been as much of a value market. You find value markets more in mature economies. So to that extent, it was even more difficult. But the good part is that we have, fortunately, we've had a good investment process, a good investment philosophy ingrained for a reasonably good length of time at Invesco. So my effort has just been to carry forward that, alongside which my own learnings and own experiences. But I've transformed to some extent. I can say that my repertoire has actually kind of widened, because earlier it was largely growth investing and growth stock picking, and that has certain elements to it. But when it comes to value, it is a completely different set of elements to it.
Correct.
So I'm now wearing two hats at a time. I'm managing two funds which are complete contrast. So one is a small cap fund which is all about growth and here and now, and
bottom up
Yeah. And on the other hand, there is this value strategy which is all about being patient, and all about buying headwinded businesses where there is no immediate excitement.
It's interesting actually you brought this story out, because I've noticed that almost all investors, right, have to deal with fear while investing. I mean, in
Sure.
every bear market, retail exits the fastest, right? At a time when actually you should be buying more. So how do you deal with that fear versus greed dichotomy?
So I think it's the process helps here, and I've been fortunate that in the last two stints, at least from the buy side standpoint, I've had the good fortune of actually having very well defined processes and systems to be able to counter this. So I think we clearly define as to what is value and what is growth, and we have set our expectations in terms of what you want out of those companies. So generally, when you're buying value businesses, you are equivalent to buying headwinded businesses, right, and not in favor and so on. I think then you get to dealing with them as such, that look, you don't have very high expectations out of them, and keep your expectations measured. And so long as it is a reasonable franchise, it will probably come out of its bad times and assert itself at some point in time in the future. So I think in value, you have that ability that at least you have made your buying reasonably cheap, such that you have a certain level of inbuilt protection, which unfortunately you can't do very easily in growth companies. Have to play the growth momentum that is on offer.
Correct.
And it doesn't come cheap. Most of the times it doesn't come cheap. But you have the support of the ongoing growth to take care of valuations being a little expensive. But on the other side, it's about buying things where you don't know how much time will it take. So one thing is about buying reasonably cheap. And keeping that margin of safety for yourself, and the other is to make your investment horizon different.
Longer,
You'll
so
have to
you can
probably
give
make
some
it
elbow room
exactly.
to
So you
this
give
stuff.
yourself a lot more elbow room.
So, you pick a
Otherwise.
lot of small caps, right? And I do know that you've picked many multi-baggers in the past, which is amazing. At what point do you lose conviction? I mean, is it after a 20% drawdown, after a 30% drawdown? Because in every bear market, small caps and, mid caps tend to fall the fastest. So, at what point do you decide that, okay, now I need to cut my losses?
So typically it's not driven by price.
Oh, it's not.
And
Okay.
price movements either on their way up or down. It's more about, once again, it's back to that process thing that we set our expectations that this is a stock from which we want X amount of growth and X amount of profitability and so on. So I think if that doesn't match up to our expectations, and we are reasonably patient, I would say. It is not that we are demanding to the extent that after we've bought from the next quarter onwards, things should start rolling. Yeah. We are reasonably patient to that extent. And we've held many of our companies, even IPO companies, we've never bought for flips, and few of them we've held on as steady companies for ourselves. So I think when the expectations don't meet up from the business standpoint, then that is a time that we rethink about them. And it doesn't matter at that point in time if the business is trading at a 52-week low or it has already dropped 30%. If you feel, and especially when it looked at it from a portfolio standpoint, that look, you now have a better idea in front of you, then there's nothing like a bad time. Right? Okay. The opportunity cost of missing out exactly is something that you would weigh. And move on. So I think it's about whether you come to that stage where you feel that you've not understood the business right, the way you probably thought it would be. And if that happens, then I think all bets are off. I mean, it doesn't matter whether it is at a 52-week high or a 50.
Okay, some very, sane advice coming through. Keep your expectations low and practice the art of delayed gratification, perhaps. Don't look for immediate returns.
These are messages which are probably very relevant today compared to at any other point of time in the past, given where the markets are.
Absolutely. So today, right, if you had 1 crore, and I'm giving you that 1 crore figure because we talk to a lot of young investors who are just entering the market, who perhaps have not seen a bear market yet. And with all your experience of 30 years, if you were given 1 crore today, how would you invest it, and what would the best way be to build wealth for yourself?
So everybody has a different template, and I think so. Again, it goes back to overall return expectations, and if you obviously I think people are getting used to very high expectations of returns given more recent experience. This is something which is not going to be sustained, and we have to be realistic about it. So I think at one level, obviously, diversity helps. I personally don't do fixed income, so to that extent, it is though I am the CIO of the fixed income business as well, but I don't personally invest. So
let me
make that admission upfront. But I have some of my own tenets, so I don't.
So you do 100% equities, is it?
Largely equities, real estate. I don't do. Real estate also to the extent it is need based, and I would do products which are new gen, like for example, more multi-asset products and those kind of strategies, which gives you a little more diversity. But largely it is equities. I would say that principally 80% of my allocation, one way or the other, would be in equities.
Okay.
So it would still be that way. I think we are still, from an economic cycle perspective, we are on course, and not that everything is hunky-dory in the economy, but I would like to think that we are still in very good shape compared to much of the rest of the world, and India will continue to offer those compounding opportunities, as we all know of. So a lot of it will have to go into equities to be able to match up to your return expectations. But if you keep them in control, and if you work with a 70-80% allocation in equities, and if you keep a reasonably decent long-term horizon, I think you should still, can you manage a 15% plus return? It's not very difficult, and especially over a 3-year, 5-year cycle. The longer the better, of course. But even a 3-year, 5-year cycle, especially considering where India is today, should not be very difficult.
So if you had to distill your entire investing philosophy into one single sentence, what would that be?
Oh my, that's difficult. No, I think the most important thing is risk-adjusted returns. You have to look at returns alongside with risk. I think most of us get carried away with only the return dimension of investing and do not give as much importance to the risk
mitigation
dimension and how do you control risk. And this needs to be balanced at different points in time in the market cycle.
Can you give me an example of risk mitigation or controlling risk?
So at a portfolio level, look, it can be done in different ways. I usually run reasonably high conviction strategies. I prefer that instead of very diversified portfolios. And it has its own, therefore, additional element of risk. If I would say, if not risk, at least volatility, because if you have concentrated strategies, it can, be quite different from the market's movement on a daily basis. But there, I think risk mitigation essentially comes from the point of view. One is that you assure the quality of businesses that you buy, which at least offers you a good night's sleep. You don't really have to wake up in the morning to some crazy headlines. At least, I mean, you'll have day-to-day events and so on, but not of the type which actually disturb the entire franchise of the organization or the business that you're buying. So long as that level of hygiene and quality is maintained, I think by and large you're reasonably fine. You then have to deal with essentially valuation-related fluctuations, and you have times when markets go crazy on certain things and either ways. So I think that brings you to the typical thing that, be hungry when others are foolish, and be a little foolish when others are. So I think in that context, what we do is that it then comes down to more. I pay a lot of attention to portfolio construct. I think as investors or portfolio managers, it's important to it's one thing is about ideation and bringing the right ideas and the next multi-bagger in the portfolio, but it's also about sizing the bet correctly in your portfolio. Whether you place it at 2% or 6% matters actually.
So if you had to point out that one skill or one emotion that you need to inculcate or develop, one habit as an investor, right, which is highly underrated, which could really change the game for you, what would that be?
No, just take a balanced approach to things is what I would say. I mean, there's no need to get carried away. I think there's also no need to do too many things. We always have that urge, especially in bull markets, to look at every corner of the world, and we feel that that's that FOMO thing that you talked about, that, I'm not in this stock, and then there are these 10 other stocks which are moving and my stocks are not, and so on. But like I said, I mean, it's been interesting. I run this, the last 4 or 5 years, we've been running this strategy which consists of only 20 stocks, and we're not allowed to buy the 21st stock by definition. And it's come about in the market at a time in the market when, you can easily think of 20 ideas in a day.
Correct.
So I think it's humbling that, that portfolio is done exceptionally well for itself.
So you churn a lot of stocks within 20?
We don't. In fact, we've not even churned as much. We do, but it's regular. It's not of the type where you're, buying a new idea every day.
Correct.
Like 30-40% churn, let's say, on an average. But point is that portfolio is delivered exceptionally with only 20 stocks, despite the fact that it is a market where you can think of 20 different ideas in a month, right? So I'm just saying that sometimes I've wondered as to what is the big thing about chasing every possible opportunity in the market, and when here you are, where you've managed it with a handful of stocks. So again, it brings back to that principle that look at your competence and look at your playing field and
forget about what others are doing or thinking.
To some extent, at least, you have to draw some lines.
Basically.
You have to draw some lines that this is your competence and this is what you want to probably.
And it's great that you've mastered that, because this is a market which has been in a dream run, right? I mean, if you look at it from 2020 to 2024, there's barely been a 10-15% correction so far. But where are we in the market cycle right now? Do you think the market has peaked out? Because that's a feeling that one gets, especially given the kind of frenzy in the IPO market. What are your thoughts?
So I think we've talked about this earlier as well, and internally too, and we discuss it. But we have to realize that a time comes in the history of every country and its own cycle where you cannot necessarily just follow things in a very templated manner. See, if you rewind back 2010, 10 years back, 15 years back, we all used to always say that, look, India is at $1,000 per capita, and when that $1,000 becomes 2,000 or 2,500 is when we hit the jackpot, and that J curve starts hitting us.
But surprisingly, the inflection point has not come, and now people are talking about when we hit $4,000 per capita.
So targets keep shifting, but I think we are there. We are at $2,500 today, and I think.
But 2,500, don't you think is like, if you take away the 1% of Indians at the top, then that 2,000 will fall to about.
So at an average, let's talk averages, and we'll have everyone in that spectrum having moved up, So someone who would have been at 300 would have progressed to 500, and somebody else at 1,000 would have moved up to 2,000, and so on. But point being that we are seeing inflections. We are changing as an economy, and I think if you look at it from an aspiration standpoint, and we all travel and we see people and meet people across tier 2 locations, metros, and tier 4 locations as well, and we find that aspiration levels in India are actually the same. By and large, everybody at their own level aspires to be at the next level or buy the next best product or the next best phone. in the market. So I think aspiration levels are quite uniform. It's now about your ability to meet your aspirations. Either you do it through your own internal surpluses or you do it through a little bit of leverage. But I think we've got there as a country, and then at the time when we've got there, we are starting. If we start to question that, is this for real, and is this something that we should? I think we should allow for that thing that we are in a new phase. So our sense is that the economy should do well. In general, like as I said, it's not that everything is hunky dory, but I think we have much of a good amount of it going for ourselves.
So as a CIO, right, I know you have 80% of your own money in equities, but as CIO, you're also managing both equities and fixed income. So what is your view on other asset classes? I mean, if there is a correction coming in equities, do you diversify into other assets like, say, real estate, fixed income, debt, or even cryptocurrencies for that matter?
So at least today, I would say for the last year, we've been luckily in that, and doesn't come about very easily, but we are in a stage where we believe that both the equity as well as the fixed income market offers opportunity. And we've seen good, rallies in the 10-year as well, and a few of our, even our fixed income business has done very well. Many of our strategies are above average and beaten the indices. So I think we are at a stage where we can probably get good, we can lock into good yields at this stage, 7% plus in many cases, and allows you that flexibility that today, if at all somebody thinks that equity markets are even for the short term somewhat elevated, you can actually add a little bit of a good amount of fixed income to your portfolio and try and balance that risk. Well, we're not looking at all the way up to cryptos, etc. But can we do something which is more multi-asset? That is something that we want to bring to the table as a house.
So when you talk about multi-asset, what would that be?
So essentially a combination of gold, it could be international securities, domestic equities, of course, and fixed income. So these will be the four main ones. But you could also probably extend yourself into other commodities as well. I think opportunities will open up in terms of investable opportunities from the point of view of products and structures in the commodity markets as we go along. There'll be exchanges like MCX, which will also provide some of those products, which you will be able to productize and put it in the form of a mutual fund and offer it to clients. So I think you can kind of diversify in this manner through different kinds of asset classes.
Multi-asset products, right? I mean, you can't not talk about the impact of AI and machine learning and data analytics. Do you think the industry that you're in is going to see a major shift because of AI?
So there is this interesting AI paradox. I forget the name of the individual who coined that phrase, but it essentially says that AI is essentially about replacing to some extent human task, right? And apparently the computing power which is required to build algorithms which can substitute the more complex activities of the human brain is much lesser compared to the computing power which is required to be built in for it to replace more menial tasks which are done by humans, such as movement of your hands or perception and so on. So the thing is that what I'm trying to essentially drive is that from an AI standpoint, complex activities of which are undertaken by humans probably can get replaced by AI as a mechanism, as a tool, but more simpler activities which are more touch and feel, which are more about perception, which are more about psychology. And we didn't talk about that, but psychology plays a most important role in my view as far as investing is concerned.
Tell me a little bit about that. I mean, in terms of psychology,
so your behavior, we talk about FOMO, we talk about missing out on ideas, we talk about greed. All these are emotions, and the level of markets being influenced by emotions on a day-to-day basis is far higher than just stock picking alone and getting the next best idea and ensuring that your corporate numbers flow through and your quarterly results come in. I think that is not as much important as getting your mental mechanism right.
So any tools that you have to deal with the FOMO or the pressure of not performing, because I mean these are cycles, as you said, right? And everyone has to deal with a bull market and a bear market. So how do you deal with the stress?
So I de-stress actually. I'm somewhat spiritually inclined.
Okay.
I do a fair bit of reading of spiritual scriptures and stuff like that alongside the regular reading, which in many cases required.
So tell me about that. Who do you read?
Not exactly authors, but there's a lot of.
Like, what is the
So
philosophy that you enjoy?
So there are scriptures within Islam, which there are courses which I attend. I listen to speakers, and it brings out a lot of principles which at some level intersect with day-to-day life, conduct, even investing for that matter, compounding for that matter, savings for that matter, the nature of savings, the nature of spending. It talks about how to encourage spending in an economy. So whenever we talk about wealth creation, we talk about taking it in, but wealth is also created by giving it out.
Correct.
And that compounds as well, and not just in terms of giving it out to yourself or to your family members, but even beyond that in the form of charity and spending yourself. So many of us have that tendency that yes, we make a lot of wealth, but we don't want to spend. And I think many economists have actually called out that sometimes the most common ill of an economy is when the spending cycle actually in the economy stops. So you hoard, you save, and when that savings rate goes up, that is the time when you actually have a problem. Today, actually, India is accused of the fact that savings rate is somewhat declining. But the fact is that it is adding to economic growth and momentum, right?
So talking about your investments, right? What was your first investment that you made? And did it go well? I mean, did you lose money? And any interesting story or anecdote you want to share with us?
Quite a number. So I think the first one obviously was at one level, it was also, my launching pad as an analyst when and I once again go way back to 97, 98, by which time it was not that I had become a very prominent investor, or very big in my investing this thing. It was still a very minuscule proportion, because I was still building the main building blocks of my life and career. But Hero Honda at that point in time, now Hero Motors, was a brilliant investment proposition which came about, and I was an analyst at that point in time, and it turned out to be the first multi-bagger, so to speak, and I never knew what multi-baggers were by then. And even today, we don't invest with the proposition that this will be a multi-bagger. I typically don't know it a multi-bagger till the time it has become a multi-bagger, so I never start with that notion that this will become 5x or 10x or whatever. And here it was, this was a company within 3 or 5 years, I think it went up 10x and some such number. And this turned out to be a very profitable investment, both from a career standpoint, because we really took that stock to the next level.
I remember Hero Motor was in Motilal Oswal's portfolio for the longest time.
And more importantly, not just the kind of money that was made on that stock by investors in general and many of us, but the point was that the kind of learnings which came out of that in terms of the kind of businesses that we need to look at. And all of us at that point in time, whether it was me, others, and Motilal Oswal, Mr. Ramdev himself, we were all on our own learning journeys of investments, because we were very early in the whole investment business in India itself. So I think it brought in a lot of lessons to us, what kind of businesses we look at, capital intensity, payouts, profitability, competitive advantages, moats. And so at one level, Hero Honda was not just about only making those investment returns and that multi-bagger, stock in your portfolio, but it was more about how to replicate those kind of learnings into other stocks, other businesses, and try and mirror the same. So
when you talk about the young investors, Gen Z, right? Everyone's talking about how to manage Gen Z, because they're a large part of the work culture as well. And now Gen Z and the younger generation is less tolerant to a lot of things that perhaps our generation was tolerant to, whether it's toxic work culture, whether it's overworking, longer hours, all of that. How do you handle all of that, especially with a young team?
So I think the good part is that we have my team we are relatively small teams. Usually our business is such which doesn't demand very large teams. But we run with, at least my own investment team comprises of 15 odd individuals. The good part is that we have a good balance between reasonably experienced people who have been around in the industry for maybe 20 years, and perhaps in our company itself for the last 10 to 15 years. And then they are working as good mentors to some of the others who are somewhat younger. But I think somehow in the investment world, I think people do come up with a certain level of established discipline. I think we have kind of arrived at a certain level of stability in our thought process and our thinking, and we know what exactly we require. So they're not as volatile in terms of their thinking and attitude compared to, let's say, people who are outside of the investment pool. So I think we require less of, that is a lesser of a challenge. But I think still how to, groom them in terms of inculcating those basic principles, making them observe as to what is happening in the markets, second level thinking. That is something which we need to train them in.
Interesting. It seems like, I mean, at least from the conversation we had, that, ever since you started your own spiritual journey, it has helped you balance a lot of the emotions to do with investing, right? Whether it's fear, whether it's greed. And it's not easy for people, especially to last consistently for 30 years. So any other key takeaways on how one should balance your mental health when it comes to investing?
So I think it is most important thing what I've tried to do is that I find portions of my day when I can dissociate, and because
Detach from
the market, because markets at some level and investing is a 24/7 activity.
Correct.
Okay, but can you spare those 2-3 hours, 5 hours for yourself outside of that schedule? And it's quite punishing. And I think it just, when you dissociate, it just gives you a lot more time to think about other things. So like as I said, it's beyond a point. I think what you're spending your time and effort and energy on is not worth it if some of the other elements in your life are not going to move in sync. You know what I mean? So I think that beyond a point, and it then that is the thing which actually starts to
eat into your professional life as well.
And eats into, more importantly, your mental status
Balance.
And mental balance, right? So I think that is what we want to avoid, and I'm trying to make an effort. I've been making the effort for the last 10-15 years. I think I feel pretty good about. I insist, for example, to my team members as well. I try to nudge them to leave office on time instead of locking in those midnight hours and stuff like that. Beyond the point, we don't need it. We all fret and fume about the fact that look, we need to put in those extra hours to get where we want to get to. But it just helps to slow down. It helps you to look at different other aspects of life. It allows you to obviously take your family along. It changes your mental setup. It brings in a freshness of thinking. It declutters your mind. I can go on and on, but I'm just saying that you just need to practice and see, and you will find that it so much changes the rhythm of your daily life cycle. And I think it's important. I do that on weekends as well. It's people make it a habit to work on weekends, and even if they were to do it from home, I don't think you need to compel yourself maybe if you're a little young, you can probably put in those extra, but over a period of time, I think that experience tells you that you need to
cut off at some
cut off at some point in time.
And also because you manage so much money for other people, right? So that incremental stress is I'm sure it's not easy. So when you have drawdowns, like you spoke about, in Indigo, there was a 30% drawdown, 20% drawdown over the years, right? How do you manage those emotions? I mean, was it easy to conquer that fear?
It came through by, looking at things in hindsight. And then, when you look at it and reflect back upon that same thing, even 6 months later, you find that, okay, you did go through it, but was it something that led to a breakdown, and did the world come to an end? It just doesn't happen that way, right?
90% of the time it doesn't.
It doesn't happen, right? And so we make it a point to stress about it on every occasion.
Correct.
When it is only 10% of the time that you will be confronted with a situation where it just goes completely out of control, right? And that's the way the world works. I think that's another thing which I've learned from my spiritual journey, that there are hundreds of different things which will happen during the life cycle of an individual and during the day, and not everything is in your control. Okay. So I think you need to understand that as well, that look, there are only few things that you can control, and we unfortunately or fortunately, we are in a business where most of the time we don't have things in our control, right? Markets are not about anything that you can control. Between 9:15 and 3:30, you have barely anything that is in your control, right? And you're dealing with this situation. It's not that you're running a shop where that okay, you'll have some traffic from X hours to this hour. Correct. And
there's a lot of uncertainty every day, so you might as well just
take it as part of it. So I think if you get yourself to gear up to that, and make your mental setup aligned to that, and the faster and more quickly you do it, I think you'll be more settled. And I've seen that it improves your overall conduct, with not just yourself but with your family, with your people in the office, and it just rubs off because people see you that how is this guy so calm in this situation when
And
so
that's the energy that you give out.
that you give out. So
Okay.
so giving out is a very important thing. I've realized that over a period of time, it just leads to that compounding effect, and
Absolutely, yeah.
we don't think about giving as much, and
As we don't think about giving as much as we think about how much we're
taking.
getting or how much we take
For
in.
us, wealth creation is
Absolutely.
only about taking in and not giving out, but I think giving out is a very important lever in terms of compounding.
Okay. Taher, it was an absolute pleasure speaking to you. Thank you so much for taking the
Thank
time
you very
out and
much.
speaking
My
to us.
pleasure as well. Thank you very much.
And that wraps up our conversation with Taher Badshah, an insightful discussion on balancing risk and growth, leveraging market cycles, building wealth that lasts, and also spirituality, which was really fun discussing with you. If you enjoyed this episode of Get Real About Wealth, make sure you follow Indie by IndusInd Bank so you don't miss out on more conversations with financial leaders and experts. If you enjoyed this episode of Get Real About Wealth, make sure you follow us on YouTube and all audio streaming platforms so you don't miss out on more conversations with financial leaders and experts.